This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money.
Well, Andrew Parsons from Resolution Capital, thanks very much for coming on Talk Your Book. There's a heap going on in the world broadly and in financial markets at the minute, so really appreciate you giving us some of your time.
Thanks. I appreciate the opportunity.
Now, I thought the best place to start would just be an outline of Resolution Capital and what you guys do and perhaps what your investment philosophy is.
Sure. So Resolution Capital invests in listed real estate. We like, as we try and describe it, as we're real estate investors that happens to be listed. We've been doing so for a long period of time in one guise or another. We started out as a team back in the mid-90s at Lend-Lease. We created Resolution Capital, transitioned into Resolution Capital in 2004, when we broke away from Lend-Lease, if you will. And all along the way, we've been invested in, as I say, when I started out, they were called listed property trusts, Australian listed property trusts. And then in the mid-2000s, we started to really, dare I say, aggressively look internationally. And we started a global strategy in 2006, late 2006, for a client, for a long-standing client. So from those beginnings, we've developed what we think to be a pretty strong long-term investment track record in listed real estate, both domestically and globally. We've now got a number of funds serving our customers on those strategies. And we recently started a global listed infrastructure strategy with a separate dedicated team.
And it's a pretty broad sector. How would you frame the helicopter view, if you like, at the minute of the global listed real estate sector?
Well, I mean, I don't know if I want to be in a helicopter at the moment, but it's a pretty dangerous world out there, it seems. Look, it's a fascinating dynamic. You know, we've obviously, I think, come through just an extraordinary period in terms of obviously the post-COVID environment and now into geopolitical events. I describe it as a very distorted market, distorted in terms of monetary policy, QE, low interest rates, distorted in terms of consumer spending patterns and the economy, employment markets, after some pretty exceptional circumstances. So I'd say distorted, but what's really gives us some degree of relative confidence, and I don't want to sound like optimism, unbridled optimism, is that the real estate markets are actually pretty orderly, funnily enough. We're not seeing the sorts of reckless behaviour that we've seen historically in terms of too much debt or too much construction development activity. And they're I use this word probably too much, but they're the idiosyncratic features of real estate that you've got to be most concerned about: too much construction and too much debt. They're the things that invariably catch the market out relative to other investment classes. And so, yes, whilst there's all this backdrop of huge change and huge challenges and unfortunate, as I say, geopolitical events, fortunately, from a real estate perspective, what we're seeing is a very, dare I say, orderly market. Now, I want to reiterate, that doesn't mean that everything's going fantastically well, because the demand side is the area that we can't have the greatest level of comfort really understanding. And obviously, as I say, given a distorted economy and facing higher interest rates and the issues in Europe, that's where we can't be unbridled confidence.
And what's the US bond market telling us about interest rates and how many hikes they're potentially going to get in over there?
Yeah, so look, basically, obviously the talk is that it's going to be a more gradual increase in interest rates. From obviously a month ago, people expected that first shock of a 50 basis point increase, and now that's been wound back to a series of 25 basis point increases. Look, that's the broad terms for what the market is starting to factor in. And how that plays out. Obviously, ask us again tomorrow, and I'm sure that there'll be a different view.
It looked like consensus was that the Fed would raise 5 to 7 times.
Yeah.
And given how flat the curve is looking, that would appear unrealistic to me. Is that sort of, has consensus shifted post-Ukraine, and have you got a view on it, or are you really taking a wait and see approach?
Oh, Chris, I've learned never to try and look too far ahead in terms of predicting interest rates. I mean, recall that back, 7 or 8 years ago, interest rates were expected to go higher meaningfully. Everybody's been waiting for them to normalise. And so trying to predict what the Fed's going to do is pretty hard, but they've been pretty good at telegraphing generally, haven't they? So I think broadly speaking, you've got to listen to what they say, and the old saying, don't fight the Fed. Well, when they were forcefully reducing interest rates, you wanted to be on the right side of that. And, they're saying that they're going to increase interest rates. I think that, that's enough to be just cautious about the view. They've telegraphed it well, but obviously, as you said, there's some pretty exceptional events taking place that might mean that that's not going to occur. But the one thing that everybody's been worried about is if there is another shock to the system, where do we go to from here? So I don't think it was foolhardy for those that claim that interest rates should normalise sooner than they have. I mean, just look at asset prices in the last 3 to 5 years. Asset value appreciation or inflation was extraordinary. And so I think, and employment markets were improving. I think there was reason for them to have moved earlier on interest rates, quite frankly. So, and hence, we're obviously hearing the discussion, are they behind the curve? And I think that is still the case. I mean, what we're seeing, and I'm sort of cutting quickly to some of the issues, what we're seeing in real estate is huge evidence of inflation pressure. US residential rents are growing at over 10% per annum at the moment. And that's quite an important contributor to the inflation CPI calculation. So anybody thinks that the inflation figures in the next 3 months are going to fall off a cliff, I think they're in for a bit of a surprise, because, as I say, key contributors, yes, used car sales were a big contributor last year, used car prices, I should say. But right now, what we're seeing is that's being replaced with very, very strong rental growth in residential market. And that's a very, very important, I think, it depends on which component, but residential's 30 to 40% of the contribution to CPI. And as I say, rents were growing at, call it 4% this time last year, 3 to 4%. Towards the end of the year, it picked up mid-late 2021. And we're seeing it carrying on at 22, 10% rent growth. So that's going to be something that the authorities have to factor into their thinking.
You couple that with the fact that oil prices look more like a crypto stock at the minute, and anyone who thinks inflation's going away is just not really thinking about it properly.
What is the definition of transitory, right?
Yeah, that's right. That's right. Do you think, given particularly that oil price spike, and you mentioned about the inflationary pressures from rents and other inputs, do you think there's any way those inflationary pressures don't lead to a recession in the next 18 months, a global recession?
Look, again, what's the old saying? The IMF has predicted 20 of the last, 3 recessions. I'm not going to make bold predictions about recessions, etc. Again, because it does depend on central planning responses. It depends on a whole things beyond my pay grade. But all I'll say is we try to think through the possibilities of every scenario and work towards protecting our clients' capital. I don't mean that to sound trite. We simply can't, predict that sort of event or that sort of circumstance. We just don't know how other things are going to play out. And so we don't spend too much time. Look, it's fascinating talking about it. And of course, we've got to be conscious of it for all sorts of reasons. But it's not something that fixates us. And
talk to me about RCAP more narrowly, if you like. What areas are you guys finding most attractive to invest in at the minute around the globe regarding real estate?
Well, as I said, residential is extraordinary at the moment. We've got a fundamental undersupply of residential property.
And is that all around the world, or specifically in certain geographies?
It is extraordinary, this global shortage of residential property, for a whole raft of different reasons. But yes, Australia is not alone, I can assure you. We're seeing similar things in Germany, in Canada, in the US, in Tokyo. Look, there's obviously excess housing in the broader Japan, as a country. You probably read some of the stories about the houses just left unsaleable in some of the regional locations in Japan. But in Tokyo itself, there's a dearth of people have moved into the cities, etc. So evidence of this was about 2 years ago in Germany. Just over 2 years ago, the local government imposed a 5-year rent freeze on apartments in Berlin. So this is not something that's just happened because of COVID. This has been something that's been building, and it's a global issue. Residential affordability is a massive issue for governments to tackle, and that's why, frankly, we've had a very substantial part of the portfolio, in fact, about 25% in residential property. And again, what's fascinating is that residential property in the listed market is quite diverse. We can buy apartments in North America, Canada, US, in Japan, in Germany, UK. We can also buy single-family home portfolios. We can buy student housing. We can buy senior housing. We can buy what's called manufactured home communities, which is trailer parks. And so it's a huge opportunity set of basic needs shelter, where there's a shortage, and rents are growing, cash flows are growing. And that's your, I'm sure it's going to become a topic, but that's your inflation hedge. So residential has been fantastic. Logistics is also performing very strongly. That's going to be an interesting area, how it performs in light of rising interest rates, and more particularly the factor that you've just raised, rising energy prices, oil prices. That's going to be interesting. But that's certainly been an area of focus for us. Self-storage. Look, if we come back, it's been summarised, cutting back to it: beds, meds, and sheds. Residential, healthcare, and storage. Now, storage is logistics storage, but also self-storage. That also has been a very profitable area. But yeah, that's a key theme of what we're doing: beds, meds, and sheds, and that represents about 2/3. If not a little bit more, of our overall portfolio.
And so, coming back to the residential housing shortage in Australia, for that to happen at a time when the first time in years we've had virtually no immigration happening here, do you see that being exacerbated once the gates open up again and we do get increased migration?
Well, it's not going to get easier, is it? I mean, look, we're just talking to an old hand in property. We had a chat with the former CEO of Stockland, Peter Daly, this morning, because he's a guy that was around in the 70s and 80s and been, so it was just a good opportunity to talk to somebody with a bit more, grey hair or hair full stop than me.
Grey hair is a first world problem around here.
Yeah, that's right. Look, it was just fascinating to talk to him about, again, the real estate market in the 70s. I mean, in the 1970s, he's saying the debt, the house price to income level was so much lower than it is today. And back then, you had a very regulated lending market. The government literally determined how much and the rate that it could be lent at. And then he said, ironically, at the same time, the zoning constraints were so almost non-existent, right? It was so easy to get zoning for land. Houses were very simple. All the infrastructure was very basic. They just literally sell off the land and there'd be a dirt road out the front, sort of thing. So that's how easy it was. Now you fast forward to 2022, and it's almost the reverse. Finance is unregulated. It's hugely available, multiple sources of debt. But at the other end, on the other side, the supply picture is so much tougher. The zoning issues of getting land zoned, of all the infrastructure, of all the constraints. And so this dynamic today has led to affordability issues that are really challenging. And I think it's, one of the unfortunate things of COVID and the government response was it just made it harder for young people. That to me was one of the really, I think, poor thinking by governments in terms of how it was going to play out. And unfortunately, it's just made life that much more stressful for young people in particular.
You mentioned before the cap on yields in Berlin in terms of rental yields.
On rents, rent growth. So rent freeze, yeah.
And we've seen...
Oh, by the way, sorry, I should just say, the government, that was then taken to the German High Court and it was overturned. But what it highlighted is local governments beholden to voters, and 80+% of Berlin residents are renters. So of course they're going to try and do anything that's an easy, quick fix. But it was taken to the High Court. It was deemed to be unconstitutional, and so that's been overturned. But again, highlighting the pressure on governments to find these quick fix solutions, which is just not practical.
Yeah, I mean, it's not the same as that, but we've seen other things happen in Australia during COVID where landlords find it much harder to evict tenants, even if they're behind in their rent. Do you think, there's some unintended consequences to some of those almost emergency policies which made sense at the time? The longer they hang around, will that make it harder for developers to create more product and fix some of the shortages you're talking about?
Look, there's no doubt it's a politically sensitive area, and let's face it, it's a socially critical area. And again, I think we have to be conscious of greater good of society. I believe we haven't had enough diversity in cities. Right? We have forced out people, to move to cheaper areas, but then we all expect these people to come into the city and the expensive suburbs to cook, clean, and service. So, look, I think that the balance is it's not an easy situation to resolve, but yeah, some of the policies I think have been counterproductive, and the big thing for me is supply. Right? I mean, this is again the funny thing. People say, Sydney's too expensive. Well, it can't be, because if it was too expensive, people wouldn't, live here. But everybody wants to live here, so it finds its natural balance, right? If Sydney was cheap, that tells you it wouldn't be actually a very nice place to live. People wouldn't want to live there. So there is an odd dynamic that takes place of finding the right balance. What we need to do is have a more healthy, diverse society in some of these areas, so that we're not forcing people to live in far-flung locations and commute in. And so, look, I don't have a magic wand solution, but I do think, to your point, we're going to be careful. You can't just beat up the landlords, right? Because, as you said, you need investment. You need to encourage supply. Supply has to come through developers. Developers need to have a set of circumstances where they can invest confidently, where there's a balance. But there does have to be a balance, and that does mean also looking after people less well off. I mean, nurses and police and all these people. I think that there must be surely more room for healthy cities to have a broader mix of residents living in communities and not being forced to, as I say, live on the fringes and enjoy a good lifestyle. So, governments have got to take a 20, 30-year view and really develop for the future and create the right urban communities, which has got the infrastructure, which has got the services, and which has affordability options. Now, that will come through supply. It's a supply and demand dynamic. We need more supply, which probably means we need more densification. And NIMBYism means people don't want more high-rise. Well, it's just a fact. If cities are going to continue to prosper, and you don't want urban sprawl because the time to travel, the impact on the environment, right? That also should be a huge consideration. We should really, I think, and it's probably not popular, we just need more densification. And that will bring about supply and more solutions. But it's got to be thoughtful supply. As I say, it's got to come hand in hand with the necessary infrastructure and services.
And going back to your beds, meds and sheds comment, in terms of industrial property and the fact that a higher portion of the value of the property is in land and less in the actual building construction. Do you see those types of property assets handling the coming inflation better than perhaps assets where a higher amount of the value is in the build costs and less in the actual land?
Well, if you're facing a higher interest rate environment and depending on growth, and that's the critical issue, and depending on economic growth and tenant demand, in fact, you actually want less land value and you want more build costs. And what I mean by that is the area that's going to be most vulnerable in the next 3-5 years is actually land.
But so what about those office investors that just value an asset on a cash flow valuation, and they're essentially buying the cash flow? Do you see, if you're buying a 15-year whale and that's been juicy in a low interest rate environment, all of a sudden in 15 years, a dollar is not quite worth as much as what it is now. Does that become less attractive or not so much?
Well, yeah. So at the end of the day, for it to be a hedge against inflation, you need a couple of factors. First of all, you need construction costs to rise, right? And that's what we're seeing. So that means that, to your point, high construction costs means you need a higher development rent. In other words, for a developer to go out and build something new, if it's going to cost them more to build it, then they need a higher rent. If I'm an existing building owner, that means that I've got a bit of a buffer against new competition, and that's how property can be a hedge against inflation. And there's a couple of things. First of all, to your point, you've got to look at real estate is not just about building, it's the land component. So land is the residual value, if you will. You work backwards. You know how much it costs to build something. You know roughly what the market rent is. So the residual remainder value is the land, and that's the swing factor. And in a falling interest rate environment that we've had with moderate economic growth, land becomes so beautiful because it doesn't cost you to hold. It doesn't cost you much to hold it because you leave your money in the bank. What are you going to get? 1 or 2%. You buy land, it doesn't give you an automatic yield, but it's not costing you a lot to own it when you're only getting the alternative of 1 or 2% in the bank. So land has been the big beneficiary of this low interest rate, moderate economic growth environment. As we now head into a different environment where inflation starts to pick up, where construction costs start to pick up, land is going to be very interesting to see what happens. And that's the thing that I think, is going to be very careful to watch for. People have overpaid for land.
And so it sounds, I don't know, put words in your mouth, but I'm interested from my own perspective, it sounds like you almost view land as the monetary inflation you get from rising asset prices, from monetary stimulation, and you the buildings benefiting from a broader inflation. Is that fair? Because we've had a low inflation in terms of CPI environment, but we've had high inflation in assets, and land's played part of that. But you're maybe not as confident land will play in the CPI inflation that's coming.
Yeah, absolutely. And so, I mean, Chris, why do you think, classic cars and stamps and wine and Bitcoins, the reason they've done so well in the last 5-10 years is because they've been a massive beneficiary of low interest rates, because it doesn't cost you to finance it when you're getting, as I say, nothing in the bank. Hey, I might as well go and buy a classic car, and provided obviously you've got this interest rate environment. Now, imagine if interest rates start moving to 10%, and then I've got to finance buying that classic car. Hang on a minute, how do I finance it? Well, it'll cost me quite a bit of opportunity cost holding that classic car. I've got to think a little more carefully about allocating capital. But in a low interest rate QE environment where money's plentiful, people are just less discerning, and it doesn't cost them as much to hold these non-income producing assets. So yeah, absolutely, these land and these other assets have been clear beneficiaries of the environment that we've experienced in the last 10 plus years.
Because I'd have the view that a high inflation environment where there's strong growth is going to be a world where that fixed asset investment looks good as to a lot of the older school type businesses, but a stagflationary environment with low growth and increasing prices just brings a much bigger risk to the cash flows you have built in from the tenant or the banking system more broadly. And then you do go back to, you've still got high inflation, but the things you want to own are perhaps back to land, perhaps Bitcoin, gold, these sorts of things. But do you have a view on that? The difference between inflation and stagflation?
Absolutely. I mean, again, for it to be hedged against inflation, again, think back, low interest, everybody isn't it bizarre? When I started out, my career sort of came into being when real estate was a hedge against inflation. Then as we moved into the 90s and noughties, it became real estate's a yield play. So, and guess what? We've now moved back to its a hedge against inflation. And then you've just mentioned the word that we don't want to talk about, stagflation. Let's leave that off to the side for a second. My point is that, look, real estate is a supply and demand game. It's as simple as that. If you don't have the right fundamentals, it doesn't matter what the inflation environment is. It doesn't matter what the interest rate environment is. Imagine if in a yield environment, real estate's a yield play. If I've got a building that I've been getting $10 million of cash from, but there's 20% vacancy rate in the office market, and I know my tenant's going to leave, and I know I'm going to struggle to find a tenant and get a much lower rent. It doesn't matter what interest rates are. That's not going to be a good investment. So you've got to have the right supply-demand dynamics, and that's the critical thing to protect yourself against uncertainty, pricing power. I can't tell you what the stagflation environment could be. I can't tell you all I can tell you is the best form of defense is to look for pricing power. And that's hard in itself. Let's not suggest otherwise. But what that means is you want to look for the areas where there's supply constraints. And you want to look for the areas that are most relevant to the economy and a growing economy. And if you can find those factors, the least supply and the most amount of tenant demand, you're probably going to have the best relative, at least, pricing power. And that should be the most competitive way you can invest your money in whatever the circumstances are. Because again, I look back, in my career, I didn't expect the property crash in the early 1990s was going to be as bad as it was. Didn't see I remember there was a Russian crisis in the 90s. There was the Asian financial crisis.
Well, the 98, the Russian one led to the Asian financial crisis, didn't it?
That's right, exactly. So then you had the dot-com bubble burst. You had September 2001 terrorism. You had the GFC. You had Brexit. Trying to predict all these events and how they play out, honestly, COVID, et cetera, I've learned, don't try and predict, just try and sensibly invest. Don't pretend that, we can't pontificate on how this economy is going to play out. All we can do is try to invest sensibly. And the best way, as I say, supply and demand. And the other thing I didn't mention is capitalization. So if you ask us what's the key, it's location, capitalization, right? You want best real estate and strong balance sheets. And that'll get you through, hopefully, whatever the economy in the world throws at you.
Very sound advice in some trying times. So thanks very much, Andrew. Really appreciate it. And that's a good way to finish. Thanks for coming on the show.
Pleasure. Thanks very much. All the best.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.